The special Market Masters episode. I'm Siddharth Zarabi. As we head into the new Samvat 2081, some of the big questions investors are asking today. How will markets perform in the coming Samvat? How can one discover new ideas and new winners? Joining us to make sense of these questions and many more, and to make it a profit wala Samvat, a profit wali Diwali, is India's top market master, Samir Arora, the founder of Helios Capital. Samir, welcome to the show. It's a very interesting time to be discussing what is likely to happen forward. But as we begin, I'm just wanting to check with you, are you concerned that the festive cheer seems to be a tad bit missing for a host of reasons, and perhaps not just external but also what we are seeing as far as earnings season is concerned, Samir?
Well, we are concerned to the extent that this is obviously not what India needs, but we are otherwise slightly happy because we predicted, at least for the consumer sector and the auto sector, that it won't do well. And actually, that's why we are having a great October, but relatively, not in absolute. But the thing is that overall, yes, we do need consumer sector to be strong over time, and we hope that going forward maybe a little bit improves because of rural economic recovery. But on the urban side, we need new themes, new sectors for the country, not just for our investing, because we don't see middle class, high level, high income jobs being created, which we can immediately connect and say, this is the new source of, middle class jobs, and therefore downstream benefits of more jobs helping those guys, and then spending. Yeah, so that is a negative. Yes.
For the new year, do you expect this cooling down of euphoria, as some are calling it, to continue? And can we see things improving beyond what is also in some ways a much needed correction?
So according to me, the euphoria has gone for some time. So if I look at the last 20 years data of the index, let us take the Nifty index. Then the last 3 years return of Nifty is at least 2% per annum lower than the previous 17 years per annum return of the index. So for example, I just did it recently, so it might be only 5-7 days off, not much more. That from 2004 to 2021, Nifty is up some 16% per annum. I'm taking the same October 2004 to October 21,
Sure.
And then October 24. It was up 16% per annum, and last 3 years it's up 13% per annum only, 1-3.
Okay.
And for NSE 500, the 20-year return was, 17-year return was 16.1 or something, so very close to the Nifty itself. And for the last 3 years, it was some 16.6%. So big picture being that this market is moving up now in a very narrow this thing. Otherwise, there is no euphoria. Euphoria, if you look at the aggregate numbers. But if you look at some stocks of mid cap or some small caps or some IPOs or some capital goods stocks, they are up 200, 300% even in 1 year. And the big picture, therefore, logic has to be that some of those where the returns have been very high, and in most cases not really supported by longer term fundamentals, but maybe somebody got 2 orders more or 2 orders less, then those will reverse.
Okay. Samir, the previous, the current Samvat really, we saw public sector stocks being among the top performers. We've seen a significant correction and then some bounce back as well. Do you think that the recent data seems to suggest that the golden period is over? And therefore, what would you forecast and foresee for these particular stocks in the next 3-4 quarters?
So I think the golden period is over. Golden period means going up much more than the market. And that needed more than just the fact that they started with very low valuation, say 3 years ago, because for the previous 10-15 years, they had underperformed a lot. But if you see the last 3 years performance or 4-5 years performance, particularly post-COVID, of the PSU stocks, now they don't look that even if you do it over a 10-year period, that they have done much worse than the overall market. Therefore, now you cannot buy them on the basis that they are being ignored or they are undervalued or that their delta in terms of changes is much more than the overall market. And also from a government point of view, also the because some of the reforms related to we were dreaming pre-elections that maybe BPCL will be privatized. The government had tried to do it 2 years ago, also the same government, and therefore there were things like that. And then all these things are now being laid to rest that are not happening. So I would think that we still own a few of these PSUs, particularly like State Bank of India and one defense company and all that. But broadly, it is now, yeah, it's now like any other sector. You can't just say because it is PSU, the theme is working, therefore desperately look for a stock like that. No need.
Um, in the near future, Samir, what are the sectors that you are still bullish on?
So actually, what has happened is that post the elections and post the budget, we thought that the PSU stocks, because of this thing that the government is now not going to be doing this very aggressive privatization type and real change in management type reforms. And so we cut some of that and we bought IT. So for us, the relative preference between the three big themes. So there are three big themes in India and mostly in the world. One is financials, one is consumer, one is IT. Okay, these are the three. And then sometimes you go off and buy some commodity, somebody like we bought some defense, somebody will buy some chemical, but those are never the largest positions in any portfolio, and they are like 5-10% you can do here or there, but the big three are always this. So in that big three, we have always liked financials and we still like financials. Financials, don't mix them only with banks, even though now even HDFC Bank and all have started doing a little better, but it means financials, banks, including state and private. It includes market intermediaries, brokers, exchanges, and therefore that sector has generally done well. These three visible big stocks had not done well, which was HDFC Bank, Kotak Bank, Bajaj Finance. So you can take your view on those. We own two of these three, but generally we like financials. The second thing that we normally used to like all our life was IT, but from 22 we had made it zero, June of 22. But about 2-3 months ago, during this budget time and election time, we have gone back into IT. Not so much that IT is some growing great guns, but that its bad news is over. And on the margin, every quarter, uh, they will give you some positive news, hopefully. And another thing is that now, if there is bad news, it won't be like the bad news that you're seeing in consumer and consumer durables, that the stocks fall 10% in a day because the expectations are so high and things like that. So IT is like a safe, somewhat hiding, but with the hope that the future is better than recent past.
Uh,
And in that's the thing.
no, just to follow up on IT, some of the data seems to suggest uh, companies in India are once again hiring, or at least they are formalizing those who are on a bench kind of situation. Globally, I think one of the big pivotal moments will be the results in November of the US presidential election. So, in terms of order flows, are substantial upticks expected? Is that your sense for IT companies heading into 2025 and beyond, Samir?
Maybe, but right now we are not thinking of very substantial change, but that the market in India and the investors will be happy if there is more positive news. So, what has been happening so far is that you were getting new orders, but your old discretionary orders were being cancelled or moderated, and TCS, or maybe others also came out, but I saw on a TCS call saying that we have this leaking bucket, which means our existing orders keep getting cancelled and reduced in scope and size, but we keep getting new orders. So now I believe that that transition is over, that your old orders, whatever they were, either the client wants them or doesn't want them, but it's not that all the time you are having to cancel, or the client is canceling the old orders. But I'm not thinking so far that you are going to get massive growth or like 20% type in earnings, which would be considered massive in today's context. But if it is 12, 15% in INR terms on sales and revenue over time, both because of base effect, that for the last 1 year it's not been very great. But more importantly, in the very short term, that there is less negative news. And if there is small negative news, it is being uh, assumed that this is like in the end phase, so it doesn't affect stock prices.
Absolutely, and the currency also has a role to play. But one more follow up on this, Samir. Have you had occasion to kind of take a medium term, longer term view on the technical capability changes and metrics that our companies, IT companies, are currently looking towards with generative AI and other technical changes? You think all of them are coping up? Because I've had a couple of results conversations with companies, and the word AI, cloud, etc., is perhaps thrown about quite a bit during such conversations.
No, true. But I don't think that Indian companies cannot deal with that. They can. So the first issue is we are ourselves not creating those AI models. That is not the target. The thing is that if we say even over time, which is possible that over 5 years, 7 years, these AI companies or AI things are negative for India, because at its very core, they are trying to replace people. They're trying to do two things. One is things that people were doing and things that nobody could do. So things that nobody could do, let's say large models for weather prediction or some large models for new drugs discovery through computers rather than by testing each and everything. Now these things nobody was doing. Please do, and it's for everybody's help. But and it's for everybody's benefit. And the second thing you are doing is things which a person with a computer was doing. You can't replace a fellow who was himself not using a computer to do his job, like a mechanic or a cook or something, but something which a man was doing using a computer, the computer can do without the man, correct? Which means Indian IT. But if that has to happen, it cannot happen in year one and year two in that sense, because all these large MNCs and all have to themselves figure out how they should use AI.
Correct.
Database said they should use, what should be the question asked, so that itself is hand holding for a few years, maybe 3 5 years. And then somebody might come out with some killer use case for AI, and then we might all panic at that time saying, oh shit, this is directly hitting our Indian. But right now it's a bit ahead. So if we look at it 3 4 years, I don't think it's changing that fast. But again, this is not the game of the stocks that we used to like, which are growing 25% per annum, like these food delivery companies or new things that happen in any market. This is more reasonable high confidence that you can make reasonable return.
Absolutely. I'm reminded of that often used term quarter se quarter tak, but let's move to financials, because you touched upon HDFC Bank. What I wanted to follow up was with the signs of recovery, do you think it will lead the recovery in the next leg of uptrend that we will see?
So the thing is that HDFC Bank has, with its this quarter's results, shown that it understood the market slowdown before others, because its asset quality is very good. They cut down their growth and all that in time. Of course, some of it was needed by them that they had to cut it down. But at the end of it, they have dealt with it better than others, and they have done it like in the past, that whatever be the reason for it, maybe it was driven by the fact that their deposits were less or whatever, but they have dealt with the asset quality best among nearly the whole set that has given their results so far. So once the market sees slightly, and say after 6 months, 3 months, because the management is itself guided that it might take another year for them to bring down their loan to deposit ratio, that after that they can grow at market plus rates. So I think they may have passed the worst in their relative underperformance. Anyway, any company which continues to otherwise do well and hold itself together and the stock does not do well for 3 4 years, generally all these things then get catch up and you
Absolutely.
get. That's a simple thing.
And Samir, it's pretty clear. No one can discount or write off a HDFC. They have tremendous staying power along with so many other stocks. Who will be the winner of the retail and the quick commerce battle? I'm sure you have read recent reportage on the QSR impact that is being seen as far as DMart is concerned. So, within the entire pack, what's your sense of how this battle will pan out?
So first of all, on HDFC Bank and on the Zomato and all, we own it. So we are interested party in all these things, mostly in everything that we will talk about. But in general, I think that the management of Zomato is too far ahead of everybody else. So what is happening so far is that if Zomato delivers, its stock price goes up. And as its stock price goes up, the other guys are able to raise hundreds of millions of dollars because the stock price of Zomato is going up. Because they themselves can say whatever they are, but they can't demonstrate in black and white how they are doing to the world. At least to the outside world, maybe the PE guys who are doing it knows a little bit, but still everything is driven by the fact that Zomato is doing well and its stock price keeps going up. So I think they've done a brilliant thing by saying that they will themselves raise money. So why should it be that I do well, my stock price goes up, and you go and raise money, telling to the competitors of mine, so I raise money, and therefore, any company or not a company, any investor which wants to invest more can give it to Zomato itself, and secondly, it makes them be able to show to the rest of the competitors that don't think that you're raising new money means that you've been given a long lead by the investor because you are small or unlisted or going for an IPO. So they have preempted that if I have a good result, my stock price goes up, and then everybody goes and gives money to the other 2 or 3 competitors. So I think it's a good thing. But otherwise, anyway, the industry is new and the TAM so far is very less. If you look at the overall Indian market TAM of retail, it might be less than 2%. That cumulatively maybe $5-10 billion for all these guys, and Indian retail might be more than 500 billion or something. So right now it's in the early stages, and these guys are doing well. We like them. We have them for some time. It's already been a 5-bagger for us. We will let it ride.
Absolutely. Well, let's move on to earnings. How are you reading the season so far, and what does it tell us for the remaining part of the financial year?
So I don't know about the financial year, but this quarter is not good so far, particularly because of the consumer and consumer durable. But as I said, we are liking it from a portfolio point of view. In my long short fund, I've been short nearly all these stocks for 3-4 months because my logic in consumer durable is that too many guys are making too many things. Every company in India in this business wants to make ACs, and the guy who makes AC wants to make fridge, and the guy who makes fridge wants to make AC. You have all these Reliances and Flipkarts and Koreans and Japanese and Indians, everybody doing the same thing, that, the Indian middle class will come and therefore they'll all buy microwaves and they'll buy ACs. And we had a very, very, very bad summer, which was very, very good for the AC guys. So it'll be highly unrealistic, but more than that, it'll be hugely negative for India if we have another summer to beat this summer. And like that. Plus, generally, the feeling was even before this, through all the reports that people brokers put out, that rural is doing better than urban, and these things are all urban. And we also know from a sense that which are the new job creations, which are the new sectors doing well. IT has not been, maybe now it will, but IT has not been hiring, private equity has not been hiring. Which are these new middle class jobs which will keep buying the same things again and again and again? And also, just like it happened after COVID in many sectors, that there was, increased subscriptions of Netflix and increased subscriptions of Disney, and then there was a peaking out, and the same thing happened in US about home investments and upgrading of home. All that spurt has happened. So now you have to go back to normal growth rates, and therefore, so I don't know right now whether it is a longer term thing or not. Uh, but it is that way. This result season so far hasn't gone well. Even the financials haven't done great results. Um, so overall, yeah, so far not so great.
Did you apply for the Hyundai IPO, Samir? And what we saw in the retail segment and overall, what does it tell us about any other IPOs that might be on your radar as well?
The funny thing is that when we talk about Indian valuations, so in many of these companies, the global companies' valuations are very low. Not just in Hyundai, for example, Nestle or Lever or any of these where Indian MNCs are there, and I mean these subsidiaries. And we say no, but the sad thing is that the Indian investor is not able to go abroad and buy these stocks there. Therefore, they go and buy the Indian guys which trade at much higher valuations. But in the case of this auto IPO, if all the FIs are bought, they know that they could have bought the parent at 5p, and in which this will be 30-40% value if some of parts, if you take the market value of what it might list at. So the FIs have still bought it on the basis thinking that the Indian market for some reason has to give higher valuation. But it would if there was on the other side an Indian public buying it. Because that was the logic that the Indian public, poor guys, don't know what the word valuations are and they can't go out and buy. But here, foreigners are buying with each other. Good luck to them.
But since we are speaking about foreigners and you wish them good luck, what do you make of?
I'm also a foreigner. Because I'm
Okay.
both. So I can choose my loyalties depending on who's acting smart. I align with them.
What do you make of FII selling trends, and is there a reversal or a stop that you foresee happening?
So I'm actually myself surprised about with the selling that has happened in October, because my logic was that India is a secular story and China is a trade. So some people who are very constrained may have to sell India to buy China, but normally they all of these investors will have many other places from where they can choose to invest in China if they so desire. As in, if it's some global fund, their India plus China combined might be not more than 4-5%. So they have 95% from which they can add 1% to China if they so desire. And if you're an emerging market fund, at least 50% of your money most probably will be non-India, not China. Actually, it might be more if you're underweight China, which is what they are trying to cover that gap. So now they are still selling. But today I saw, I'm not 100% sure whether it's correct, but because it came on WhatsApp, but they are showing what was the sales in China itself in October from and they were that slide or whatever that thing was showing that Indian selling is about 7 billion and China is 14. So that means it is not India to China. Somebody selling both. If somebody is selling both, then it may be connected that they think about US elections, because if US puts these high tariffs on China, by the way, Donald Trump's interview, not interview, but that discussion on whatever, it's like an interview only, was saying that India also, I have to do something because Indian also put tariff on US products into India. Who knows what this thing is? But I think that at the end of the day, uh, this will get resolved one way or the other, but I still don't think this is good enough to be negative on it. Even if you look at this month, 5% the market is down. No, not even 5, 3.5% the market is down. Not the end of the world. It's like a normal correction. And this is in the face of 7, 8 billion of foreign selling. Although some of it might have come back in the IPOs.
Absolutely.
FIS screen, yeah.
Samir, a follow-up on this China point. A lot of observers are saying that what China has done is not enough considering the real state of its economy, including sectors like real estate. And we'll get to see what they do and how they do it. They're pretty opaque for at least us outsiders. So will the US election and what China does further forward be very, very crucial as far as FII's approach to India is concerned in November and possibly before the Christmas season sets in?
So as I was saying, my thinking is that China, even if somebody wants to be bullish, it doesn't have to be at the cost of India.
India.
It is possible that India underperforms if China does well, because that is like a quick reversal of a very low valuation, like a value. It's like when PSUs went up a lot, it doesn't mean that the rest of the market had to go down, but that their valuation was being corrected. So that's what I thought and think, that India cannot keep going up if China keeps falling. So in some sense, it brings some stability. It also improves our relative valuations. Otherwise, everybody will keep saying, "Oh, India premium to Asia," which basically is driven by China, or India's premium to emerging markets, which is being driven by China, has become very high, and this and that. So we may underperform, but if US is doing well and China is doing well, it is unreasonable to think that India will not be up. It may go up less. That's okay for now.
Within this October fall, Samir, what were you buying and what did you add?
So as I said, this month is one of our better months for my long short fund, because actually I'm up this month primarily because I was short the consumer stocks.
Okay, you are having a good pre-Diwali run-up.
For me, this month has been good on a relative basis, because all my views that I had for 2-3 months suddenly came through. Because all these stocks are down 10. This month my shorts might have, I don't know, might have made 5-6% on shorts, which is great. But generally, now slowly these will have to be covered. So far, what has happened with new money, there was not much of new money during the month because the whole market is otherwise falling, is to buy a little bit of IT, more of IT.
More of IT. I have two questions that have come in, so I'm going to take them as the last two on our conversation today. The one of them is that gold has outperformed equities in 2024 so far. So you're being asked, are you tempted to diversify and add more gold and silver?
So, my fund is a pure equity fund. So I buy gold and we don't buy. But personally, I've held some gold in the past. Gold has a logic now, because you see this global debt situation is going out of control. It is very difficult to say what happens, whether it takes 5 years or 3 years or 10 years. So gold is a good hedge. And I personally own maybe 5% of my total this thing in gold. Second thing is that after the US basically took away Russian dollars, all the reserves that they had were basically said, sorry, thank you very much. And
$600 billion plus.
600 or whatever it was.
Yeah, absolutely.
Yeah. So, and actually, supposedly I read they were not even dollar, they were euro dollar or something, which means that it could not have been, but they were taken away. Means that why should why should sovereigns who even slightly feel like even Chinese government, little bit even Indian government, why should we put all the money in dollar and maybe everybody's buying more gold up to whatever level they can, so that the reserves are in their own control?
Absolutely.
Actually, from that time only, if you see the gold has gone up. Now you may connect it to war or you may connect it to US decision on this.
Absolutely.
But it scared many people. Many people means even these big offices, big families or big oligarchs and everybody who were, suddenly lost.
Absolutely.
Yeah.
Samir, there are 3 or 4 IPO related points that have come, questions that have come for you. I'll quickly crunch them into one. I think it's linked to Hyundai. So you're being asked that what should retail investors do considering the current IPO frenzy and some more IPOs that are currently lined up? So broadly, how should retail investors approach forthcoming public issues?
So for retail investors participating in the IPO, they should go ahead and participate. A, you won't get a lot of quantity. It's more like a lottery, so you're participating in the lottery. But please, you don't have to buy on day one of listing. I mean, you saw all these IPOs which go up, 50, 60, 40. First of all, so it's a chicken and egg. Because if people say that, okay, we'll buy in the IPO, but we won't buy on listing, if the listing 30, 40% higher, then mostly the IPO itself will not be successful in theory. But we don't have to analyze what in aggregate it means. But the bottom line is these IPOs are not coming at all cheap. The IPO is getting massively oversubscribed. You are participating in a lottery, you're putting up money, you're not going to get a big deal. Even if you get a little bit, either it goes up and you make a few thousand or you lose. It's not changing your life, but it's good, small pocket money. But please don't buy on day one of listing. That is my general advice. It makes absolutely no sense. If you saw this recent IPO of the housing finance company, it would be down 20%. You see that electric two-wheeler down some 20%, maybe not on day one, but after 4 5 days in that case. This day one of just because the issue was oversubscribed 50 times, please understand, nobody wanted 50 times higher number of shares. Everybody gave an order of 100 because they knew you will give them only two. And if
Absolutely.
you gave an order of 100 and you gave him 3, 11 heart attack. So it
Absolutely.
does not show that there is, 50 times higher demand. There is no 50 times higher demand. The demand is that only, but everybody is inflating so that you get that total whatever they can get. And therefore, on day one of listing, nobody should touch. I think then you don't lose much. You're okay in life.
Absolutely, and this FOMO factor that seems to drive some investors, that's very, very avoidable. One final question, and we've got a question which says that you often emphasize investing in high quality stocks. What key indicators or metrics do you consider when determining the quality of a company? I know it's a very big question, but as the last point on the...
I have this presentation on my Twitter also and other places. We actually don't say like that. We say two things. One is these stocks which are, you can call it high quality. I call them high confidence in reasonable return stocks, which are mostly high quality stocks. Because what is high quality is something which has done well for long. And therefore you feel comfortable with it, and therefore you start calling them quality. The management has not disappointed you, the industry is good and all that. But now if they have been accepted as quality, then it's not that only I know they are quality, everybody knows they are quality because they have had a public track record for many years. Therefore, there your returns will not be obscenely high, but they'll be good. Good means better than market by say 2, 3, 4% per annum. The other one is where we are discovering, like when we bought Zomato, the price was 52 rupees and was crashing all around. And like that, we have maybe 20 companies you can see in our domestic mutual fund portfolio. You'll be able to see the different positioning. Those stocks we are buying and betting in aggregate. Each stock in the beginning might be only 2%. Total, they are 50%, 40%. But each will be 2%. Then the guy who does well, very good. He has done something better. But we are therefore reducing our risk by not betting on one and saying, this is my multi-bagger I found. But when I find 20 such companies, some, if 8, 10 of them do very well and some do okay and maybe 1 or 2 do badly, it's enough for me to outperform. And so that is the way to play it, but not to put anything and saying, oh, I have discovered my next 100 bagger. Because according to managements of those companies also don't know that shit, really? Are we so good? They also don't know. Everybody is trying hard, and then for some it bears fruit, and for some it is like a story that I got everything right, but I made one mistake, and that is how life is. You cannot
Absolutely.
actually get that right for everybody.
Absolutely, you can't get everything right. But Samir, you got several calls right, and more power to you on that front. Thank you very much for taking out the time to take our questions and questions from viewers that came in. There were many more, but we are out of time. With that, it's a wrap on this conversation with Samir Arora. We'll be back with more on our pre-Diwali Market Master series in the run-up to that big festive day. If you've been, thank you very much for watching. We'll slip into a short break and be back with more on the other side. See you very soon.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and in this special video, we're going to be talking all about the FIS sell-off. If you too have been looking at the selling spree that's on, well, you should be looking at what are the key reasons FIIs have been selling. Is it just about the China factor, or is it more to it? And what is that? What is it that top market experts are saying about this huge selling spree that we are seeing? In fact, FIIs have broken all records when it comes to selling in the month of October. Foreign institutional investors have sold nearly $10 billion in shares in the secondary markets so far in October. And according to the data from National Securities Depository Limited, FIIs were net sellers in the secondary market